If you're planning on investing in the stock market, one of the most basic things you should know is what type of business you're going to own. If a company is on the stock market, it's a public limited company. But what does that mean? And what are the other types of business? We'll take an insight into sole traders, partnerships, private limited companies, and public limited companies to give you a sound understanding of what they are and what it means for the owners. In this video, we're going to focus on the public limited company. A public limited company is one that can be owned by any member of the general public through the use of the stock market. In the UK, public limited companies are governed by the Companies Act, which states the statutory minimum capital requirements of the company. Shares are offered to the public subject to conditions of limited liability. Well-known companies such as Apple, Microsoft, Amazon, and Kraft Heinz are all public companies. In general, the most well-known and famous companies in the world are public limited companies, which means that any member of the public can own at least a small share of the business. This is great if you're trying to save and invest for your future, because rather than putting your cash into a bank account that has a low interest rate, you can invest in a company you choose, buying a stake of that company's future profits. Your money is more efficient when it's in use, so let's look at some of the characteristics of the companies you might invest in. First of all, you should know that the business and owners are separate legal entities. The shareholders are not legally responsible for the business, only their investments into the business. Effectively, if you own 100 shares of a company listed on the stock exchange and it defaults on its debts, you are not personally liable for the business's debts, but you may lose your investment into the business as your share price could drop to near zero. Next up, unlike a sole trader or a business that depends on an owner, if one of the shareholders passes away or becomes insolvent, the business is unaffected. It's important to note, however, that if a large shareholder defaults or is forced to sell their shares, a large increase in the supply of shares of that company will temporarily push down its price, depending on the liquidity or ease of transactions in the market. Registration is an important characteristic of a PLC, as they must register themselves with authorities, comply with all laws, have the capital requirements necessary, and be accepted onto a stock exchange through an initial public offering to achieve the funding they require. When a company is traded on the stock market, it is listed. The company must submit formal accounting yearly to Companies House and are required to fully disclose all accounting information to the public. Press releases, insider ownership disclosures, and all further information related to the value of the business must be disclosed to all members of the public at the same time. This prevents insider trading and some owners having an information advantage over others. The business can get funding from capital markets, meaning it can issue debt and equity. This means that the business has the fuel to grow at the pace the managers see fit, as long as the market agrees. This is where you come in as an investor. You can lend the business money through purchasing some of the debt, or bonds, or you could purchase a share, an equity stake, in the business, which means you take an ownership interest. So, consider that you wanted to make your private business into a public limited company. What would you need to do? Firstly, you need to make sure you're registered as a company with the government regulator. Next, minimum capital requirements must be fulfilled. This is £50,000 in the UK. Finally, you must meet the accounting disclosures mandated in your country of registration. This means filling out the financial statements, tax returns, and payroll information, which requires a lot of expertise. Now we've covered the key characteristics, let's look at the advantages and disadvantages. Limited liability means the business is a separate legal entity, which protects the owners from legal fault. Owners can use the business to create more tax-efficient income, where they can make themselves a salary and top this up with dividends after paying corporation tax. The incorporated business can legally protect their name, as others cannot trade under the same or a similar name. The business can raise capital more easily by selling additional shares of the business in the stock market, or by issuing debt through bonds. Finally, the business is more likely to do business with other companies, where large corporations are more inclined to do business only with other incorporated businesses. Moving on to the disadvantages, let's take them in turn. The business now has certain legal requirements to fulfill, such as annual accounts, corporation tax returns, setting up a payroll, and producing VAT, value-added tax, returns. If the business misses any deadlines, they'll have hefty fines to pay and will face more legal issues from their shareholders. Unlike a sole trader, the owners cannot readily and easily take cash out of the business to supplement their personal income. They have to pay salaries and dividends to transfer cash, which must be taxed. The setting up and closure of the business is a little more lengthy, although quite straightforward. Setting up requires registration with Companies House and informing HMRC, Her Majesty's Revenue and Customs. On the other hand, closing the business can take 3 months, as to dissolve the business is complex and costly. Finally, as the company's shares trade publicly on the stock market, any entity in the market can purchase shares, meaning that hostile takeovers that the directors of the business are against can still go ahead if the shareholders are willing to sell their shares.